Let's now have a look at learning objective number 3 that looks at recording and posting adjusting journal entries and preparing an adjusted trial balance and financial statements. Now, let's just keep this simple. Basically, what we want to look at in learning objective 3 is how to record adjusting journal entries. Now, one thing that I would like to remind you about and make you aware in relation to adjusting entries is that there are at least 2 accounts that are affected by every single adjusting journal entry recorded. One of those accounts is in the statement of financial position, and another one of those accounts is in the statement of financial performance. So that is the income statement and balance sheet respectively that we have been looking at throughout the teaching session. So I want you to keep that in mind. For every single adjusting entry we record, at least one account out of the income statement and at least one account out of the balance sheet is included in that adjusting entry. So let's now move on and look at a series of examples related to adjusting entries. And the first one that I want to discuss today is called a deferred revenue example. So this is where the business receives cash up front from the customer and provides the product or service later. So therefore the revenue is deferred away from the acceptance of the cash. So in this case, it says, suppose a company sells a 12-month subscription to its monthly magazine. So for example, if I subscribe to Evo, they send me a magazine, one magazine for the next 12 months. So I pay for Evo in advance, and then they send the magazines throughout the period and meet their obligations to me. So if I'm one of the subscribers out of 12 people subscribing and paying $100 for the subscription moving forward, Evo, the magazine company, receives $1,200 in advance and therefore is obligated to send the 12 subscribers one magazine each month. Now, let's look at the original transaction. So if we look at the original transaction, it says that on October 1, they recorded debit cash $1,200 and credit unearned subscription revenue $1,200. And this is a normal journal entry. This is not an adjusting entry. Essentially what is happening is we are recording the receipt of the asset. Assets are increasing, so we debit cash for $1,200. And we are recording the fact that Evo has an obligation to its customers in the form of $1,200 worth of product that they are obligated to deliver, so future magazines. So to increase a liability, you credit the liability account, which in this case is unearned subscription revenue. Now the question I have for you is, by the end of February, how much have they earned? So how much has Evo magazines earned, right? So remember, as I said in the prior information, they accepted $1,200 on the 1st of October for a 12-month subscription service. So from the 1st of October until the end of February, how much has Evo magazines earned in terms of revenue? Please answer the question now. So what I would like to discuss now is how much has Evo magazines earned from the 1st of October until the end of February. And that's basically the adjusting entry we're looking at recording. So what we're assuming here is the 28th of February, so the end of February, is equivalent to the end of the financial period. And the question is, Evo accepted cash up front for the subscription revenue. The period ends on the 28th of February. How much revenue out of the $1,200 that they originally received have they actually earned from the 1st of October until the 28th of February? And here the answer to that question is $500. So where did that come from? So remember, we originally accepted $1,200 in cash as payment for future delivery of magazines. So from the 1st of October until the 28th of February, 5 out of the 12 months have passed. So that means the magazine company has earned 5/12 of the revenue they accepted up front. So 5/12 of $1,200 is obviously $500. So when this magazine company reaches the end of the financial period, which for them is the 28th of February, they record an adjusting entry here. So we'll just remove this text from the front so you can see it more clearly. They record this adjusting entry of debiting unearned subscription revenue 500 because originally we started out with a $1,200 liability we owed customers. If we have delivered $500 of that product to the customers, we no longer owe them that amount. So therefore we can reduce the liability by $500 by debiting the unearned subscription revenue liability. Now, of course, given we have now earned that $500 in revenue, we need to record that so we can report what our actual performance is for the period ended 28th of February. So we credit subscription revenue for the $500. Now, what you will notice here, as I mentioned earlier, is that there is one account that is affected in the balance sheet and there is one account that is affected in the income statement. So liabilities are being decreased in the balance sheet and subscription revenue is being increased, which is reflected in the income statement. Now, to describe what's happening in a bit more detail, if we look at the T account for unearned subscription revenue, you can see that when we originally received the $1,200 payment, the balance of that unearned subscription revenue account was credit $1,200. When we record this adjusting entry, we are of course decreasing unearned subscription revenue of $500 and therefore reducing the liability balance of this account to $700. So this is why it's really, really important to record the adjustments. One, so we can report what our actual revenue is for the period based on what we have earned. And so we can reflect on what our actual liabilities are at the end of the period based, again, on what liabilities we have paid off and met our obligations to customers, in this case, for the unearned subscription revenue. So let me ask you the question now. If the original transaction was recorded as a revenue rather than a liability, what would we do? Now, I know a number of you are probably watching this and thinking, that doesn't sound right. The business has taken 12 months of subscription revenue up front, taken the cash off the customer, and is obligated then to provide that customer with the magazine subscription and delivery for the 12 months moving forward. So how can this business record this as revenue? Because they haven't earned it. And that is the correct logic. You most certainly cannot recognize that revenue and report that in the financial statements at the time the cash was received. However, in saying that, what happens if the business recorded this particular transaction, right? So what happens, rather than recognizing the current liability of unearned subscription revenue, the business instead records subscription revenue when the cash was received. And of course, debits the cash account accordingly. The same as the prior transaction we looked at. Now, I'll come back to it again. A number of you are going to say, this is wrong, this is not how you do it. And that's fine. I accept that. But one of the key things we need to learn with adjusting entries is that you are adjusting the financial records to actually recognize the revenues of the business and the expenses of the business. So if someone in the business originally recorded the receipt of the 12 months of subscription revenue as this transaction here by crediting subscription revenue, then when you record the adjusting entry, you need to adjust this so we actually recognize the revenue the business has earned when we record the adjusting entry at the end of the financial period. And that's when all adjusting entries are recorded. Remember, they're recorded at the very last point, at the very end of the financial period, to essentially adjust all the records to reflect the financial performance and position of the organization. So if we accept that this is how someone recorded that transaction by debiting cash and crediting subscription revenue, we need to fix this up so that we can actually recognize the actual revenue that the business earned during the period. So if I go to the next slide, on the next slide, this is the adjusting entry we will record in this case. So what you can see here is that the business, of course, by the end of February, as you calculated in the question that I asked you, has earned $500 of revenue. So the 5 months from the 1st of October in the prior year to the end of February in the current year. So if the business recorded, if we go down to the T account, $1,200 in revenue when they originally received the cash, then of course, what do we need to adjust? Well, we need to adjust the $1,200 down to the actual amount of revenue that has been earned, which is $500. And that is what the adjusting entry needs to do. It needs to adjust it from $1,200 in revenue down to $500 in revenue. So we know that to increase our revenue account, we of course credit. So if you want to decrease your revenue account, what do? You debit the revenue account, okay? So you debit subscription revenue by $700. That reduces the subscription revenue T account of $1,200 down to $500. So $1,200 credit balance when the transaction was originally recorded minus $700 reduction gives you $500 balance. And therefore, through doing that adjustment, we have actually recognized the correct revenue earned over the 5 months to the end of the financial period. Now, in association with that, we have also adjusted the liabilities that we are recognizing. So notice here that we credit unearned subscription revenue. So when the transaction was originally recorded in this case, there was no liability recognized of any kind. Now we know by the time we get to the end of the period, the business has, of course, a liability on hand that it needs to recognize. So 0 is recorded prior to the adjustment. The actual ongoing obligation of this particular commitment is 7 months of magazine delivery outstanding to the customers, right? So therefore, by crediting unearned subscription revenue by $700, we are increasing unearned subscription revenue, so the current liability account, from 0 to $700, giving us a $700 balance at the end of the period, to therefore actually recognizing the liabilities for the period. So this is a very important part of learning what adjusting entries are all about. We can see here that we are adjusting 2 accounts. One of them affected the income statement and allowed us to recognize the correct amount of revenue for the period. And the other part of the adjusting entry allowed us to recognize the level of liabilities that the business essentially owes to its customers. Now, as I mentioned earlier on, if you have any questions about any parts of what we're covering here, make sure you ask on the discussion board or you ask in the tutorial. Let's have a look at this example now. It says, assume an accounting firm agrees to provide service to a client for $1,000. The firm completes its work on September 23 and bills the client on October 10 and receives payment on October 21. The firm closes its books on September 30th. So September 30th is our end of financial period in this particular case. That's when we need to record the adjustments so that we are recognizing what we have earned from a profit perspective and the associated financial position of the entity. So what we can see here is the firm agreed to provide the service. They then completed the service on September 23 and they billed the customer, the client, later on, and they received the payment on October 21. Now, this is an example we've gone through a number of times in this subject. When do you actually recognize revenue? Do you recognize it when you get the cash, or do you recognize it when you've actually delivered on your obligations to the customer? The answer to that is, as you know, and consistent with the revenue recognition principle, is that you recognize revenues when you earn them. So this business, of course, has earned the revenue on September 23. The client is then billed on October 10. That makes no difference as to when we recognize the revenue, and they receive payment on October 21, which is nice because the business receives some money. But again, the business doesn't earn the revenue then. It earns it when it actually does the work. So we know that the business in this case has earned the revenue prior to the end of the financial period on September 30th. So in that particular case, because they have yet to receive payment and they have yet to record any transaction here, they need to adjust the financial records in order to recognize the $1,000 of revenue the business has earned during the financial period. So the adjusting entry, if we go to the next slide here, will look like this. So here we have, and I'll remove this text so we can see it more clearly. Here we have debit accounts receivable, credit service revenue. Now, as you know, the business has earned the revenue. So of course, by crediting service revenue, we are recognizing the revenue at the very end of the financial period through this adjusting entry. And we are also recognizing the fact that the customer owes us the money. So we are recognizing a current asset of $1,000. So the expectation that we will receive payment from the customer reasonably soon, at least in 12 months, because accounts receivable are a current asset. So as a result of recording this adjusting entry, what you can see when we look down at the T accounts is that service revenue, we increase it by 1,000, so that's the final balance of that account there. And the accounts receivable, we have $1,000 outstanding, so that's the balance of that asset account there. And so at the end of the financial period, we're actually able to report on what our performance and our financial position is for the period. Okay, so there's a couple of examples on adjusting entries. Let's move on to this one, and let's have a look at a deferred expense example. So suppose on March 1, a company purchases a 12-month general liability insurance policy for $36,000. So this is on March 1. Purchase this policy. It is a 12-month policy, therefore providing 12 months of insurance, and that is the value of the policy. This is the original transaction that would be recorded at the time that economic event occurred. So the business acquired the insurance policy. And what you can see here is the business on March 1 debited prepaid insurance because the business has acquired a current asset, which is prepaid insurance, has ongoing benefit moving forward, and use cash to fund the acquisition of this asset. So we credit cash, which reduces the cash balance by $36,000. So essentially our asset balance remains the same, but we have redistributed our assets. We've increased our prepaid insurance and we've decreased our cash asset. Now, the question I have for you that I would like you to answer right now is, if the company is preparing its financial statements at 31 March, how much of the $36,000 12-month insurance policy has been used up? I would like you to answer the question that will be appearing now. Okay, so what did you answer? Well, let's think about it. The business acquired this insurance prepaid asset on March 1, and the financial period ends on March 31. So they have used 1 month out of a 12-month insurance policy. So 1/12 of the $36,000 policy is equivalent to $3,000 of insurance that has been used up over that financial period to the end of the period, which is March 31. So what is the adjusting entry that we need to record on March 31, consistent with the fact that 1 month of the insurance policy has been used up throughout the financial period? Well, I'll remove this text here so we can see this more clearly. Just let me take this box out. There we go. So what you can see there is that firstly, I want to take you to the bottom of this adjusting journal entry. What you can see there is we are crediting the prepaid insurance asset by $3,000. So therefore we're reducing the value of that asset by $3,000. And we are recognizing that we have used up that asset, right? So we have used up 1 month of benefit. So the asset amount is therefore transferred to an expense account. As you know, expenses refer to using up resources in the business. So we debit insurance expense for $3,000. So notice that this adjusting entry still results in the accounting equation balancing. We have reduced our asset value by $3,000, and we have also reduced the value of the business through incurring an expense and recording the expense by $3,000. So both sides reduced by $3,000. So one of the points that I want to go back to last week, I talked about retained earnings. And I talked about the fact that you never, ever touch retained earnings until you get to the very end of the accounting cycle, which I will show you at the end of this particular workshop. Never touch it otherwise. So if we incur an expense, we record it as an expense. So in this case, debiting insurance expense. If we generate revenue, so if I go back a few steps and we talk about revenue, right? So here we have revenue. So if we generate revenue, we, of course, if I go back a couple more steps, there we go. If we generate revenue, we, of course, credit the subscription revenue account in this case. We never, ever touch retained earnings when recording adjusting entries and recording transactions. Okay? So please keep that in mind. You always use the actual revenue and expense account that the transaction or adjusting entry relates to. Now, going back to the deferred expense example that I mentioned, so remember it's deferred because we paid up front for the asset and therefore the expense is recognized once we use that asset up. If we look at the T accounts as a result of the adjusting entry that we recorded up here, you can see that we started with prepaid insurance asset of $36,000. We reduced it by $3,000. So therefore, at the end of the period, in the balance sheet, we'll be reporting prepaid insurance of $33,000. We also recognize that we used $3,000 of resources up. So we recognize an expense of $3,000 insurance, which we report in our income statement. Now, remember the situation I mentioned before. How we record the adjusting entry relates to how the original transaction was originally recorded. So what was originally recorded, if I go back a few slides here, was that in this case, when we acquired the prepaid insurance, we credited cash, obviously, and we debited the prepaid insurance account to recognize that asset. And for most of you, that will seem very logical. You've acquired an asset and you are therefore increasing the value of that asset through recording this particular transaction. So we recorded our adjusting entry to reduce the value of this asset accordingly by recording that adjusting entry that you can see there on your screen. Now, going back to the scenario, what happened if someone recorded it differently? What happened if when the insurance policy was acquired, rather than debiting prepaid insurance, insurance expense was debited? Now I know what you're saying again. You're saying, no, this is wrong. It's not an expense because the business has acquired an asset which has future ongoing benefit. However, that doesn't matter here. All right. Yes, you would record it like that if you were recording the transaction because that is the best way to record it. But if this is how someone in the business has recorded it, then you need to adjust this accordingly to make sure you recognize what the actual assets of the business are and what the actual expenses are. And if we get to the end of March, so March 31, and we leave this transaction as is and we don't adjust, then we of course have recognized $36,000 in insurance expense at the end of the period, which of course is grossly overstated. So we want to reduce the $36,000 expense down to $3,000, which is the actual expense from March 1 to March 31, from when the policy was acquired to the end of the financial period. So the adjustment that we would record is, of course, this particular adjustment. You would reduce the expense by $33,000. So to increase an expense account, you debit it by $36,000. And so therefore to decrease it, you credit it, but in this case by $33,000. As a result of this original transaction I'm highlighting up the top here, you didn't recognize any prepaid insurance asset. So through this adjustment, by debiting the prepaid insurance asset, you are increasing that prepaid asset recognized from $0 to $33,000. So therefore, the information that you report in the financial statements after recording this adjusting entry will be consistent with the assets the business has and the expenses that have been incurred during the period. And if we go up and we look at the T accounts, the T accounts would have looked different because, of course, if you just recognize an expense, you would have had $36,000 here and $0 for prepaid insurance here. But as a result of the adjusting entry that I showed you here, as a result of this way of recording the original transaction, you will arrive at the same final balance of the prepaid insurance and insurance expense accounts. So think about it. As a result of this adjustment here, you increase your prepaid insurance balance in your T account from $0 to $33,000, which is what the final balance should be at the end of the period, and you reduce your insurance expense T account balance from $36,000 down to $3,000 by reducing it by $33,000. So you'd end up with a balance of $3,000 in the insurance expense account. So remember, always very important to look at how the transaction was originally recorded and then how it should be adjusted accordingly. Okay, so I have another question for you. So payroll is $1,000 a day, so daily payroll. The company pays its employees Saturday for the work the previous Monday to Friday. The company prepares its financial statements on April 30th, which is a Friday. How much do we owe the workers on April 30th? That's the question I would like you to answer right now. Okay, so how did you answer the question? Well, if the financial period cut off on Friday, so that was the very end of the financial period, and that's when we need to prepare our financial statements. It doesn't matter what's going to happen the next day. It doesn't matter that the day after the financial period, we pay our employees what they are owed in terms of their salaries. That is the next financial period, and we will record the relevant transactions and adjusting entries related to that period in that period. What we're interested here is that the financial period cuts off on Friday night, and therefore we have incurred payroll expenses for that Monday to Friday period, but we have yet to pay the employees. So when we put together our financial statements, of course, we need to recognize that there is an amount of payroll expense, so salaries expense, that we have incurred but yet to pay. So if the daily payroll in this case is $1,000 a day and employees are working 5 days a week, then of course 1,000 times 5 is $5,000. This is the adjusting entry you would need to record. So you would of course debit salaries expense to recognize the expense that's been incurred of $5,000 to the end of the financial period. and you would credit salaries payable of $5,000 to recognize the fact that you owe employees this money, but you have yet to pay for it. Now, I know what some of you are saying. You're saying, well, why is the salaries expense we are recording only related to the week prior to the preparation of the financial statements and the year end, or the financial period end in this case? Why is that the case? Well, remember, what would have happened last Saturday prior to the Friday we are recording this adjusting entry? What would have happened is the business would have paid its employees $5,000 in salaries. And this is a transaction. So when a transaction occurs, right? So when something crosses the economic entity boundary, so we take $50 out of the business, we give that to the employees. What happens in that particular case is we record a transaction at that time. And so therefore, when we record that transaction, we would debit salaries expense and credit the cash that we paid. And so therefore, we have recognized all the salary expenses throughout the whole period on the basis of those transactions recorded. We are only recording an adjustment here, and the adjustment basically closes the gap from when we last paid employees and recognized the expense to the end of the financial period when we have not recognized any salaries expense because we have not paid employees for that period of work. So accordingly, in that case, you need to record the adjusting entry just for that gap between when it was last paid, which was last Saturday, and what you owe employees but is unpaid at the end of the financial period, so that you can recognize what the total expenses are for the period and what the liabilities are outstanding at the end of the financial period. Now, when employees are actually paid, what happens in that case? Well, this is the subsequent transaction that follows, right? So on May 1, the Saturday when employees are owed their salaries, then we pay them their salaries payable. So we reduce salaries payable by debiting the account. And of course, we recognize the cash we're using up to pay those salaries. So of course, your salaries payable account will then be zero during the following financial period when you've actually paid out the amount that's owing. Now that of course is a transaction, because a transaction is crossing the economic boundary. So the entity concept, you're crossing the economic entity boundary and employees are receiving their salaries. Now, to sum up before we move on to the last part of this learning objective, we've gone through a series of different adjusting entry scenarios. We've looked at deferred revenue, which is where we essentially receive the cash up front and we recognize the revenue later. Accrued revenue, where we earn the revenue and we receive the cash later. And the same concepts apply for expenses. So deferred expenses is where we pay for something up front in cash and we recognize the expense later. Or accrued expenses is where you recognize the expense now, but the cash flow follows later. Do I want you to memorize this table I'm showing you here? Absolutely not. I don't want you to memorize it. I want you to apply what you've just learned through the different exercises that you will complete for your homework and discuss in your tutorial Zoom sessions in order to learn this, apply it. And therefore, when you look at this table, it will make complete sense to you. Don't memorize it, understand it, and review it after that. Okay, let's go back to a familiar example that we looked at last week. Last week, we looked at Circle Films in the workshop and we recorded a series of journal entries for the purpose of that example. Today, what we're going to look at is closing the loop. So last week, we recorded transactions only. We recorded economic events occurring and we recorded the relevant journal entry at the time that economic event occurred. Today, remember, what we're concentrating on here is adjusting the financial records at the very end of the period so we can comprehensively report on what the financial performance is and what the financial position of the organization is. So what I want to go through now is a series of examples that relate to adjustments that we're recording for Circle Films, and then we'll consolidate all that information together to generate the final financial statements for this business. So let's start with adjustment number 1. Adjustment number 1 says, on July 31, Circle filmed the retirement reception for a customer who paid $2,000 on July 10. Okay, so let's have a look at adjustment 1 for Circle Films. So it says on July 31, Circle Films filmed the retirement reception for the customer who paid $2,000 on July 10. So basically the adjusting entry that we want to record in this case is the fact that Circle Films has now earned the revenue. They received the cash from the customer on July 10. The end of the financial period for this business is July 31. So accordingly, given that they have earned the revenue prior to the end of the financial period, we need to then recognize that revenue. So in order to do that, we of course credit service revenue for $2,000 and we debit unearned revenue for $2,000. So accordingly, if we look down at our T account here, we reduce our unearned revenue liability from 2,000 by 2,000, therefore giving us a balance of 0, and we increase our service revenue from 5,000 by 2,000 to 7,000 at the end of the financial period. Okay, second adjustment for Circle Films. So remember, the end of the financial period for this business is July 31. This business filmed the first night of a 2-night play. The second night will be filmed on August 1. So that is August 1 is in the following financial period. Then they will bill the customer. The customer has agreed to pay $1,500 for each night. So accordingly, in this case, we need to recognize what revenue we have earned up to the end of the financial period. So in this particular case, the end of the financial period is July 31. So therefore, what we do is we need to credit service revenue by $1,500 and we need to debit the asset we're receiving. Now the customer will pay after they've been billed in the next financial period. So we debit accounts receivable, the amount we expect from the customer of $1,500. The third adjustment here is after a physical count, Circle determined that it had $650 of supplies remaining. Now, what I want to do here is I want to show you how do we actually work out what this supplies expense is here, which is showing as $350 in this adjusting entry. Now, if we go back to last week's class, we learnt that Circle acquired $1,000 of memory card supplies. So if we do a stock check and we find that we have $650 of supplies remaining, which is therefore the final balance of that asset T account. That's what's left, so that's what the balance is. So if we started with 1,000 and we're left with 650, what left us? Well, what left us was $350 worth. So businesses are not necessarily going to count and track every single item, right? So for example, if in a business we have a stationery cupboard and someone takes a pen out of that stationery cupboard, someone is not going to record a transaction because someone took a pen from the cupboard, right? So someone at the end of the financial period will look at what's left and therefore what did they start with and what did they add during the period to work out from there what was actually taken out. And what we can see here is what we started with was 1,000. What we're left with is $650 worth. So therefore we've used up $350 worth of supplies. So we recognize this reduction in supplies by crediting supplies, 350, and we recognize the associated expense by debiting the expense account by 350, and specifically we debit supplies expense. Let's now move on to adjustment number 4. Adjustment number 4 relates to interest that's charged on a promissory note that is a 6% promissory note. Now the assumption here is that whenever you are provided with an interest rate on a loan, it is an annual interest rate. So the loan might go for a month, it might go for 6 months, it might go for 5 years. But the interest rate that you are provided with is a standardized interest rate. So that is, it is stated on an annual basis. So if the loan is a 6%, therefore annual rate of interest charge, if we have the loan outstanding for part of the period, then of course we need to calculate what interest expense has been incurred for that part of the period to the end of the financial period. So in this particular case, we took out a loan, as we saw last week, to purchase a video camera that cost $9,000. This video camera was purchased a month prior to the financial period end, so on the 1st of July. So if the end of the financial period is July 31, we have incurred a month's worth of interest expense that we have yet to repay. So the lender has not required us to pay any cash for interest at this stage by the time we reach the end of the month. So what we do here is we multiply the $9,000 by the 6% interest rate by the period out of a year this interest is owing for, right? So 9,000 multiplied by 6%, multiplied by 1 month the loan was outstanding from when it was taken out to the end of the financial period on July 31, gives you $45 of interest expense that has been incurred. So in that case, we debit interest expense by 45 and we credit interest payable by 45. So here we're recognizing on the bottom that we have an incurred liability and therefore we will need to pay $45 worth of interest at some point in the future based on what liability we have incurred during the financial period that's just ended. And we recognize the fact that we have used up $45 of resources. So we've incurred this $45 interest expense to the end of the financial period. Now, the last adjusting entry that I want to discuss today in relation to Circle Films relates to the use of a long-term asset. Now, depreciation relates to using up an asset over time. Now, let's talk about how depreciation affects an asset value. So let me get this copy of Wheels, right? And if I turn to the very back cover, here we have an ad for a Mercedes C63S Cabriolet. Okay, looks very nice. So this car will cost you about $170,000, $180,000 new. This car has a finite life. Now, yes, Mercedes-Benz promote themselves that they make excellent quality cars, they last a long time, etc. But we know that eventually it will reach a point where it is no longer economically viable to keep this particular item on the road. So therefore, we know that things decline in value over time, the useful life of those assets decline in value over time. So the type of asset that we look at will relate very much to how much we should depreciate that by per period. So depreciation basically means how much of the asset value do we record as a depreciation expense to reflect the amount of that asset we have used up over the time period. So let me ask you a question right now. So my question to you is, which asset will depreciate at a higher percentage rate in the first year of acquisition? Now, in order to answer this question, some of you would have thought about how long will this asset be useful for, which is ultimately answering the question as to what its useful life is and therefore what period of time we depreciate it over. Now, I asked you specifically in this case, what asset will have the highest rate of depreciation in the first year? And some of you would have indicated the smartphone. And that's a good answer because for a lot of you, you might have your phone for 2 years and at the end of 2 years, it's worthless, doesn't work anymore, etc. and you need to buy a new one. So that basically means for every year you own it, you use up half of the value. So the percentage rate of depreciation is 50% per year because you assume you generally get nothing for a phone at the end of its useful life. Okay, some of you would have said a supercomputer has the highest rate of depreciation in the first year because A supercomputer is really useful in the first year, might give your firm a competitive advantage in the first year, and so therefore you want to reflect a higher percentage rate of depreciation in the first year to therefore reflect the higher earning potential of that asset. Some of you might have indicated an office tower, although this one will typically depreciate over a much longer period, maybe 20, 30 years. Taxis generally are depreciated over the legal life that they can be kept on the road, which I believe in New South Wales is around 5-6 years. Okay, so the value of the end item, so the end point of the taxi's life will be relatively low, a few $1,000s, and so they will depreciate an amount each year, so record depreciation expense based on the useful life of that asset over time. So with the taxi, what we take is, say, the acquisition cost, which could be 30,000, the scrap value, which could be 3, so therefore we depreciate $27,000 worth over, say, 5 years, divide 27,000 by 5 years, and that gives you the annual rate of depreciation of that asset. So if we look at adjustment number 5, what we have here is a recognition that Circle's 2 cameras are only going to last a finite period of time. So it provides us in this case with the rate of depreciation in dollar terms for the period that we're reporting on. So it says that their 2 cameras total depreciation was $600 up to the end of the financial period. So all we do in this case is we record and debit depreciation expense of $600 and accumulated depreciation of $600. Now, some of you will have no issues, or most of you will have no issues understanding why we debit depreciation expense, because we've used up the asset and therefore you need to report that expense in the income statement. But the accumulated depreciation, what is that all about? Well, basically what that's all about is it is the accumulated value of what has been depreciated over the life of the asset, which you want to report in your balance sheet. So for example, if we look at this Mercedes again, the original value of this Mercedes, if we reported it in our balance sheet, would be $170,000. That original asset value would remain in the balance sheet. But obviously we know as the years go by, that product is worth less and less and less. So the accumulated value that's less and less and less that we have depreciated is captured in the accumulated depreciation account. So if in this period we record $600 for the cameras, that stays in that account going forward until we scrap that particular piece of equipment. So in the next period, we record $600, then the total value in accumulated depreciation at the end of that period would be $1,200. Okay, and the end of year 3, it might be $1,800. It gets accumulated in value over time. So when you look at the original asset value in the balance sheet minus the accumulated depreciation, that then gives you the net asset value. Now, if we look at the statement of comprehensive income or income statement for Circle Films, and we go through and we look at the statement of changes in equity that captures retained earnings, and we look at the statement of financial position, which is the balance sheet, which we've discussed before, we will see that there are differences compared to the profits in the financial statements for this business that we consolidated together in the last workshop. Why are there differences? Why is the profit that we reported last week only $2,750, whereas the profit we report here is $5,255? Well, the reason for that is because we didn't record the adjustments at the end of the financial period like we've done today, and therefore the accounting records weren't up to date, and we had missed out on certain revenues that outweighed the additional expenses through the adjustments. So therefore our profit is of course higher when we record all the information that relates to the entire financial period. We therefore have the total profits we have earned for the period, and therefore we also reflect in the balance sheet all the assets and liabilities that are associated with these adjustments we recorded. So this is an essential step in the accounting process. You must record all the adjustments at the very end How do you consolidate all those adjustments into the final accounts to generate these statements? Well, the answer is exactly what we did last week. You post the transactions to the T accounts that we looked at. So remember, we looked at these T accounts last week, right? So we had a T account for every single account. We consolidate all the information into those T accounts, and therefore we then generate the financial statements based on those final T account balances. Now, one of the things that I've mentioned to you a number of times in this subject is you need to keep up to date with what is happening in the world of business. And as you know, there is a lot happening in the world of business. And I recommend that you look at the ABC Business News page regularly. So if I bring up that page right now, you can see there's a lot of information about different organizations. As you can see here, the aviation sector is very heavily affected by the coronavirus. There has been massive swings in terms of retail activity. Some retailers like supermarkets are doing really good. Other retailers are doing really, really badly, and so on. We can see that there are different aspects of the economy being affected in different ways. And whenever you evaluate the financial performance and position of an organization, you need to evaluate it relative to the context in which the business is operating in. So when we look at these numbers that I showed you today, say for this business, is this good or bad? Well, it ultimately depends on the relative context the business is operating in. Circle Films, in this case, is filming weddings, it's filming functions, and as you know, in the current context, all those type of activities are banned. So you would expect the financial performance of this business in the period that this relates to would be absolutely shocking. And you might look at that and you go, well, that's terrible, but then you assess it relatively speaking, and you can understand that it is not a management or operation error or bad management. It is just the fact of the economic context as a result of the coronavirus that has been occurring